having me.
Thank you. Can everybody hear me okay?
No.
Can you hear me? Any better? Good to go? Thank you for joining us today, everybody, for what I hope will be an informative discussion on market real estate valuation and pricing trends. I'm Dan Klein with Physicians Realty Trust, and grateful to be here, and grateful to be in the presence of this esteemed panel of experts from whom you'll hear shortly. And I will introduce them, and as we get into questions, if they want to delve further into their background, they can. But on my left, Farron Melton from MBRE, excuse me.
Maybe she works at Chris Bobby Real Estate.
James Schmidt from Anchor, Evan Kovac from JLL, and Shane Seitz from Ventas.
We can't see you because we're being blinded by these lights.
We'll pretend there's an audience.
Yeah.
And I so wish that I was on The Price is Right for those of you at the lunch today, because that would have been a great opener. I'm going to just use his opener from now on because it was so good. But I don't have that, so we're going to delve right into the data and the comments from our panel. We've got some questions I've prepared, but please feel free to raise your hand anytime, yell, shout, and we will kind of stop and address your questions as you have them. We'll also leave time at the end for questions if you want to hold them at that point. Okay, so let's get into it. I'm going to start probably in this order. Farron, what valuation trend surprised you the most in 2019?
I think, can you guys hear me okay? Great. So I think one of the things that was most surprising for us in 2019, really just the rate of acceleration in which we saw cap rate movement in 2019. So I personally have been working with MBRE for the last 6.5 years in the medical office space. And, we've seen a continued trend of just cap rate compression, but the rate at which cap rates compressed in 2019 was remarkable, frankly. And it was challenging to stay on top of. That would be probably our top thing.
I would agree. James, what do you think?
Just the amount of continued institutional interest in the sector. It's probably become cliched at this point to talk about non-GDP correlated investment class and end of cycle investing, things of that nature, as the U.S. commercial real estate cycle sort of stretches into 10-year plus type of runway from the last downturn. So it seems to be thematic. There's a lot of institutional capital that sees the space for investment as sort of a means to get at some of those concepts.
Thanks, James. Evan?
I agree with Farron. I think continued cap rate compression. If you think back to the end of 2018, it's sort of easy to forget, but we hit a period of market disruption. The 10-year Treasury went up above 3%. Some of the REITs were trading at discounts to NAV. It felt like the stock market was falling, government was shut down, et cetera, and it kind of felt to a lot of our clients and to some of us that we might have finally been on the front end of a disruption or a recessionary period, and then fast forward 3 months and the 10 years back down to 1.5, 1.75, 150 basis point compression. The healthcare REITs are trading at big premiums, the stock market's going crazy, and as a result of that, just continue to see cap rate compression all throughout the entire 2019, really. It felt like pricing just continued to elevate every single day.
And it still is, which is the crazy part. Things are getting more expensive. There's so much capital that wants into this space. I mean, there's not much to add on this end, so I'll kind of keep it short. But Farron's point's spot on. Cap rates have just compressed so much. I was at a conference in the fall with another REIT who said, hey, by the way, good luck, welcome back to Ventas, but it's a knife fight out there. I kind of thought, I was like, oh, whatever, it's not that bad, right? It's a knife fight out here. It really is, and it's because there's so much demand for product, and there's so much new capital that wants to come in. You look at the funds that are out there raising money and who've been the aggressive buyers. When you look from 2001 to 2008, who the buyers were, when you look at from 2010 to today, who the buyers have been, it's been pretty dramatically different, with the exception of Welltower making some pretty big moves in the last year. It was mainly institutional capital moving that needle. and there's so much more demand that institutional capital realizes and recognizes how beneficial it is to have a healthcare allocation at this point. We're a real asset class. When I started 20 years ago, you struggled to find equity, you struggled to find debt. You had to explain every single time. It was like trying to explain to somebody what a crawdad is. Nobody knows what a crawdad is, but that was like what it was with an MOB. So
let's delve into that a little bit more and continue.
Crawdad part?
With that, not the crawdad part, thank you. That'll be a follow-up later. How low will it go? How low can it go? Evan, let's start with you because you've got kind of a broader view maybe than the rest of us, but where do you see any kind of natural bottom to cap rates if you do?
Tough to say. I mean, if you look at the public markets, MOB is trading inside of all the asset classes except for multifamily and industrial right now. So I think to a lot of people, it already feels fully priced, and returns are, with very competitive returns. Although to Shane's point, when we thought it couldn't get any better in 2019, we're continuing to see compression early part of this year, and I think a lot of it is just all the liquidity in the market, all the money that's being raised. The REITs have a great cost of capital. The private equity investors are shifting from other asset classes to recession-resistant type asset classes, and we're hearing in a lot of meetings that to be competitive, investors are either becoming more aggressive in terms of how they're underwriting. They're going back and looking at historical performances and figuring out how they can tweak underwriting, and also just adjusting their return requirements and expectations, or sometimes a combo of both. So how low can it go? I don't know. I mean, it feels like it's continuing to go lower though.
Yields dropped again, right?
Yeah.
Precisely.
Cost of debt is less than it was 2 weeks ago. If that stays, we'll see, but that has an impact. And for all this institutional capital, they're not leveraging up, but they are using leverage, and the cost of debt today is a lot less than it was, a year ago, 2 years ago, which blows my mind. We all we're in this low growth environment, and we're going to be here for a while, it feels like. Now that I've said that, it probably will change, because I'm always wrong.
Do you feel like that's defensible analysis and underwriting to go back and look at that, Evan, and the rest of the panel? Or do you think maybe that signals movement toward a top, or maybe rather a bottom on cap rates?
Comes a time, you're going to do your underwriting the way you're going to do your underwriting, right? The nice thing about having the public REITs, we all report all of our secrets. You know what our renewal probability is, you know what our rent growth is. We're pretty open, we're pretty transparent. That helps all the other buyers in the market, which is, a lot of people look at that and say, well, that's not good, you gave away your secrets. But it's really great for us that all this capital wants to come in. It makes us more liquid. It makes the valuation for us that much better. The compression in the cap rates just makes all of our stocks more valuable, which gives us more ability to actually grow our businesses. But looking back at what you've done versus what you're going to do, you have to stick with your principles. If you start getting too crazy with things, you're going to get yourself in trouble. It's being sane, being consistent with what you've always done. You've been in the market for a while. I've been in the space for 20 years. Dan, you've been around for a couple of years. Schmitty's been around forever as well. Evan, Aaron's been around for a while, 6.5 years, so you've seen some stuff. But, healthcare real estate is what it is. You have to understand the healthcare before you understand the real estate.
Dan, where I think people can and have sharpened their pencils a bit is when you're underwriting what may have historically been considered a quote value-added transaction, or somewhere where you're making the market bet on leasing or occupancy or capital improvements or conversion of space to medical use or things of that nature. So, look, I think core assets are what they are. There's not a lot of them. There's cheap core money out there to buy them at low yields. I think in general those yields have been relatively stable on the low end. Where I think there's been the most movement, frankly, is in the transactions where people think they can create some value over time. I think that risk-adjusted pricing has gotten bid way down. What might have been referred to as a value-add transaction in years and times past is now in that core plus category, and debt obviously has helped make that conclusion a little bit easier with cheap debt, because most of the buyers of a core plus or a value-add investment are going to use leverage. So cheap debt allows people to be a little bit more aggressive, but at the end of the day, if you're going to do that and those returns are going to compress, what you're going to have to go back and look at is how quickly can I get leased up? How can I value engineer the improvements I've got at this building to create long-term value enhancement? Those are the things that I think around the edges people are having to get smarter about.
And I think that's the risk with more money coming in and not necessarily understanding it, is that a building that's been vacant or hasn't been well occupied for a long time, there's probably a real reason why it is. So you have to understand the business and understand the changing in the delivery of the care to know how to change that building, to make tenants want to come there. Or if you have a building that's not ever going to get filled up, you have to recognize that, and cut bait and move on in a lot of ways. So I think new money coming in really has to understand the healthcare and the operations, or if they're just coming in to buy real estate, like one of the other 4 sectors, they're going to have some hard lessons to learn along the way.
Yeah, we would completely agree with that. We've definitely seen a lot of compression on the value add space. And one of the reasons we see, and especially as we talk with our peers in the market, we do see a lot of capital that is trying to get very smart. They're asking a lot of questions. They're new in the space. They're trying to figure out how to operate, who to operate with, what are the nuances of medical office, because medical office is its own special beast. And those who are asking the right questions and getting smart will do well, and there are some that, will have more challenges.
So what do you think about Spencer Levy's suggestion, I guess, today that, for those who were at the luncheon, that, you return to core. Let's not chase value add, let's not chase tertiary markets, let's return to core because we have continued compression. Do you think that's valid, not valid? I hope he's not here.
He's not, because his name badge is right there. So.
Yeah, there's just limited product to do that with. I mean, the biggest challenge for most investors is they have too much money to put to work. And it's an asset bubble. It's not just in this space. We see it in other real estate and hard assets and stocks and bonds across the globe, really. I mean, people are chasing yield, chasing return, which continues to bid those things down. Our sector is no different. The medical office space in the United States has I would say, built-in advantage from an investment perspective that supply is generally driven by demand from tenancy. You're not getting speculative building. It's rare to see people taking big leasing risk. I mean, look, we're amongst the most active developers in the country, and I can't tell you the last time we took on a project of any material size that had a big leasing component to it that was going to extend very far into construction. It just isn't happening.
What's your typical pre-leasing?
Almost everything that we've built in the last 2 years has been fully pre-leased. Even when we've had some vacancy, it's filled up during construction. We've taken little to no leasing risk on over 1 million square feet of construction that we're doing right now.
Yeah, what about you, Farron? What's MBRE doing for their development pre-leasing?
I mean, we're pretty much the same. We're largely pre-leased by the time we have shovels in the dirt. But the other thing, too, to kind of go back to the original question, I think that the thing for us, we always stick with just the core of medical office. Medical office is there to serve communities. Every community is in need of healthcare services, whether it's in a gateway market or whether it's in a tertiary market. And for those reasons, we're always going to be chasing credit, chasing the right tenancy in those secondary and in tertiary markets. And, there are just going to always be those types of value add as we see opportunities outside of the core gateway markets.
I agree with James. I think we're in a market with limited supply. We have, on a good year, $10 to $15 billion of sale transactions, right? And I would argue that very little of that is true core. Everyone has a different definition of core. So, maybe $2 billion of truly core assets trade every year, and to build a strategy around exclusively investing in core medical office, I think is difficult in concept.
Right.
Where's Steve Bolin? He can talk about that.
Yeah. So Oriel Herman only comes around
once every 10 years, maybe.
Yeah.
And look, institutions struggle with that. It's one of the biggest things that they have a hard time getting their heads around is your average transaction size is $15 to $20 million in this sector. And look at the graphs every quarter after quarter. You have a sloping line downwards once you move past 15 or 20 million in terms of number of transactions. You can count on one hand or two hands the number of transactions at $50 million for single assets. What does that mean? Among other things, it rewards folks that can thematically aggregate portfolios over the course of time and bring something to market with scale. And Farron, I'm sure, can talk a lot about what they've done recently, which validates that thesis. But I think that, that has been true regardless of cycles. So it is work to assemble a portfolio bit by bit, but if you do it the right way, I think in the long run, you get paid for it.
Yeah, I would definitely agree. And the work behind it is really understanding the operations for each of those assets, understanding the tenancy, the credit, obviously, building those really great relationships from the ground up. And at the end of the day, we're, an operator first, and we want to make sure that we're doing the best things by our investors as well as by our tenants. And
I think Evan made a great point, which is define core. Right? So core in medical office, by our definition, is going to be very different. All five of us will define what a core MOB is compared to an institutional capital group that has been buying office buildings. What's core to them? The metrics don't line up in the same way. They want a gateway city. How many gateway city deals have we seen done in medical office building? One or two in Boston and New York, one in San Francisco, a couple in Southern California, maybe. Been in the space for 20 years, maybe a couple $100 million worth of stuff, maybe $1 billion, if you're lucky, in 20 years.
Yeah, fair point.
Oh, I was going to say, for ultra core, I would agree with that. I mean, you can count on one hand the number of ultra core trades.
Yeah, maybe on two fingers.
Maybe, depends on the year.
Yeah.
Okay, well, let's switch gears a little bit, get into the lightning round. I will propose a few either-ors to you all, and you can expound for a minute or two on your thoughts on that. And I'll probably pick on, let's go with James to start with. I've got 5 or 6 of these. Jump in if you have questions. And we'll go down the line here after I hit James. Development or acquisitions, James?
It's a good time to be a developer if you're building pre-lease product and you're building to an attractive yield on cost. So, our development pipeline is as robust as it's ever been. I will say that not everything is owned these days, so there's a fair bit of fee-for-service business that comes with that. But owned projects continue to be, value creators for firms like ours. And so, while we do a lot of acquisitions volume, and the reality is, as a developer, those deals are oftentimes, they take forever to incubate, but the value creation comes out of them significantly.
Are you seeing the spreads compress?
Yeah, inevitably, you see more, as I said, more willingness for systems to simply own their own product, and you'll be brought in as a fee-for-service developer. You've seen more structured financing. You've seen less pure equity ownership of traditional real estate, from my perspective. So yeah, I would, and for the, that means scarcer and scarcer opportunities for the traditional equity joint venture type development structures. So as a result, a lot of those yields have been driven down a fair bit.
Well, I think the systems have gotten smarter. The health system's gotten much smarter. They understand that they understand the valuations and where those have moved. For those that have been around a while, we've seen them move. The cap rates, I would have never guessed that we'd be where we are today. Development yields have compressed almost to the point that you're paying full price for development at this point, just so you can feed your pipeline, because there's such a lack of quality product in the market.
I would say,
It's Evan's fault.
yeah, that's always my fault.
Largely.
I would say acquisitions, I think, in a core plus type acquisition, there's still some opportunity to add value. And to James' point, a lot of these development deals are so competitively priced and the spreads are so narrow for marketed development opportunities that there's not a lot of yield there necessarily, unless you control good land and, can flop the leverage with the health systems or the potential tenants.
Okay. Fair?
Yeah, I would definitely say, I'm probably biased because I sit in the acquisitions vertical, so acquisitions on our end. But to speak a little bit on the development side, we had 190 million in starts last year and 150 million this year. And I think for us, we're definitely seeing, as James mentioned, we're seeing compression on the spread. You know, when I first started, you know, we would see 100 to 150 bips, and today, you know, just as Shane was suggesting, health systems have gotten so smart. You know, we might see that spread at 25 to 75 bips, if not all the way down to anything. And it's just, you know, there's no pricing for that development risk, which is very real. It's not that development risk has gone away, yet they're expecting the pricing premium to have.
And Dan's company keeps messing it up too.
Yeah, you guys
what do
definitely
we-
aren't helping.
Well, I don't know, you tell us what you do, you keep messing it up for me. Tell us your secret sauce.
It is one of our goals. Okay, did you answer the question, Shane?
I feel like I did.
Okay, well, we may not, but that's okay. Single tenant versus multi-tenant,
Multi-tenant, every day.
okay, why?
You know, the thing that we like about multi-tenant is that when multi-tenant is done well, it creates an ecosystem within, you know, the building itself that becomes really hard to break up. It just makes sense. It increases renewal rates. It makes for happy tenants that just aren't going to go anywhere. When you have, you know, your ortho and your imaging and, you know, all of these complementary services talking and speaking with each other. You know, the multi-tenant, we just love. Single tenant, they can pick up and go whenever they
Less so.
like.
James?
Pros and cons, it's expensive to run a multi-tenant building, costs you a fair bit in capital between TI leasing commissions, CapEx to keep that facility up. You're dealing with common areas and you're generally dealing with a fully managed building. The advantage to a single tenant building, generally, oftentimes it's self-managed by a tenant. The downside, of course, the binary outcome of the end of the lease. I would say from a development perspective, in my mind, it's becoming more of a build-to-suit market. So you're seeing more and more larger projects for single health systems who want to put a bunch of services under one roof, which leads to a long-term credit, often credit-oriented single-tenant type structure. From an acquisitions perspective, I feel like on a risk-adjusted basis, although it's more expensive to manage and to keep up a multi-tenant building, generally you're taking less overall risk, particularly if you've got staggered lease roll.
Thanks, James. Evan, you're not buying them or selling them, or not buying them, but thoughts on?
Yeah, I mean, investor capital, and I agree with James, pros and cons to both. I think, obviously, my preference would be multi-tenant, less binary risk, but as you go up the quality, or down the quality spectrum and start to move deep into the secondary and tertiary markets, I would definitely tend to gravitate towards single tenant. I think there's a lot more liquidity in the market, buyers that are looking for single tenant when you start to add in the net leased universe as well.
I'm indifferent. I'll buy both of them. I mean, it just depends on what it is. There's so many, it's like, what's a cap rate? What are all the variables to a cap rate, right? Single tenant makes a lot of sense if you have that ecosystem with a health system, if you know why they chose that location off campus. There can be a lot of good reasons to do a single tenant deal. Multi-tenant is still a great investment class, so I'm indifferent. I'd love to buy both at a 9 cap,
Yes.
like back in the day.
Back in the day, those were the days.
Those were the days.
Although 20 years, you must have started when you were like 6.
You know that I'm 7. I was 7 when I started. Don't try to date me.
You've come a long way.
I know, thank you.
Okay, so let's start the other end. Shane, primary market, secondary market, tertiary.
You know, I think we have assets in all markets, primary, secondary, and tertiary. We've had the benefit of making our first MOB acquisition, I think, in 2004. So we've had the ability to kind of watch the maturation of those buildings, those tenants, kind of how those buildings are used now, comparatively how they were used then. I think there's some challenges to the tertiary markets. Yes, they'll always be there, there'll always be a demand for them, but you're limited on how much rent growth you can really get out of them. You can't grow rent in perpetuity. Primary markets are obviously have that growth, have that demand. Secondary markets that are up and coming look really good. So, you know, I think that we probably tend to shy away a little more from the tertiary markets. I think historically I would have said that I enjoy tertiary markets because there's always a demand for healthcare, but I think from an investment thesis, there's definitely some challenges and some uphill challenges with that investment market.
Do you sort markets by where you can ski or bike?
I always try to.
I'm kidding.
But yeah, sadly, no.
Evan?
I would say secondary markets. I think the primary markets are fully priced. There still might be a small yield opportunity in some of these secondary markets, and as new capital enters the space, particularly the private equity that may not have the long-term background in ownership and operations, they typically want primary markets, and they slowly start to migrate up the risk curve in terms of market preferences. So I think you'll see more and more liquidity in secondary markets, and maybe slightly more opportunity for some compression.
Well, you're also going to see in the primary markets, those are our core markets. So those institutional buyers are going to want to buy in those core markets, and it's going to be a little more competitively priced. And the buyers of those assets, REITs or institutional capital, are going to be longer-term holders.
Well, and back to your point earlier on definition of core, I would say that a lot of investors have different definitions of primary as well. Is it top 10? Is it top 25?
No, it's top 50. It says it right there.
Right.
Thank you, Revista, for providing us with that.
It's settled then.
Yep. It's top 50.
Top 50.
Hopefully, as I've gotten older and perhaps a little wiser, I've learned I don't want to chase yield, whether that's going up the acuity risk spectrum, whether that's trying to extend into smaller or weaker demographic-oriented markets. Look, at the end of the day, healthcare is ultimately a retail consumer decision. You're looking at that micro market and making a decision about what's driving services in that building. That said, the markets turn bad, which they inevitably do at some point in time. You want to be in positions that are going to retain liquidity, and liquidity is going to come first and foremost, most likely from bigger institutions, well-capitalized institutions, and the knee-jerk bias, for better or worse, is bigger markets. I feel a lot safer at the end of the night in having to pay a little bit more to be in the best locations, because at the end of the day, they're most likely to be the ones that have the least amount of volatility in the downside market.
Fair enough. Yeah.
So just like Shane, we're playing in all three, and I think the thing for us is that we go where it makes the most sense. At the end of the day, I think secondary markets have been particularly interesting for us, just because, as Evan pointed out earlier, we're just seeing a ton of competition, obviously, in those primary markets, those top 50.
Thank you for re-clarifying that it is the top 50.
It is the top 50, yes,
It's the top
exactly.
50.
We're just seeing more competition there, not necessarily able to get the type of yield that we'd like to be able to see, where we are able to get at, say, in some of those secondary markets. And one of the things that we're really able to leverage in our shop is just, obviously, we're spending a lot of time boots on the ground. We're spending a lot of time getting very smart on operator credit. We ask a lot of very difficult questions, and we feel like we're able to get a lot of clarity, so we can make really smart decisions about who's the best-in-class operator, even for some of those secondary and tertiary markets. So that's been good for us. So in short, we'll do all three.
Okay, well, we'll turn it right back to you. Investment grade, non-investment grade, or credit, less credit, sometimes no credit.
Yeah, I'd have to just go back and say again, it's the same thing. It's like, as long as we can get smart on the credit, we'll be happy with either. Yeah.
A couple things on that. One, it continually surprises me how little attention at times the risk element of reimbursements and overall exposure to the healthcare operating business these investments get. Look, the ACA's all over the place, the political landscape's all over the place. I realize that people at a basic need are going to need health service, but I do think that risk oftentimes gets underrepresented in the overall macro thesis of investing in this sector. Credit, it also makes me nervous that the ratings agencies are competing for business, and there's a ton of credit buildup at the very edge periphery of investment grade credit, BBB minus oriented credit, and certainly had experience in recent years where profitable systems are generally shied upon by ratings agencies if they're standalone, if they're independent, if they're over leveraged. And that can lead to unintended consequences to ratings downgrades. And if you're going to make that bet, you can't be betting necessarily that rating is going to be stagnant. Understand what is going to ultimately lead to profitability for the health system, and understand what's driving the business. Start there first, as opposed to a representation by an agency in New York competing for business and subject to the whims of the market.
Wait, did rating agencies make a mistake at some point in our cycle at any point? No, not at all, right? I don't want to steal your thunder.
I was going to say exactly that.
Sorry. Pretend that Evan said that.
Thanks, buddy. I would say that underwriting credit, to James' point, goes well beyond just looking at the credit rating that's assigned to a tenant. With that said, short answer, buy with no credit, hope for a credit enhancement, and sell with credit, which I think has been every...
We didn't realize that long ago, but yeah, that's definitely a thing. And it's going to continue in that direction.
Yeah.
Right? The physicians coming out of school now want to be employees. They don't want to have private practices. All of us that own buildings with 2,000 square foot tenants in them, that's great, but we really need 20,000 square foot tenants. All of our tenants want bigger, larger spaces. They want to go from 2 clinics down to 1. They want to take 5 clinics and make it into 1 clinic and have it in 1 floor and make it more efficient and use that space more effectively than what they have in the past. I agree. Look, I'll look at credit, non-credit, I'll look at all of it. But really at the end of the day is I want to be with the number 1 or 2 provider in that market. I want to understand what their market share is. I want to understand why they have that differentiation from the number 1 or the number 2, why they're going to retain that position or why they're going to lose that position. I have to understand that market and that thesis of that tenant, whether it's a hospital or a health system or even just a physician group. If they're the number 1 or 2 provider and they have a good thesis on what they're doing and how they're going to grow their business and how they're adapting to the delivery of healthcare, then that's my partner that I want to be involved with. Because at the end of the day, I'm just a partner in owning this real estate. If I make them upset or if I impact their ability to provide service to their patients, then I'm no longer their partner. They're not going to want to be my tenant. They're going to move out.
That's great stuff. Thank you all. I've got a few more, but we'll come back to them if we have time. I want to move on to some bigger picture questions, and whoever wants to chime in, chime in. Does a recession or continued status quo affect your investment thesis?
Look, we're a publicly traded company, so we have the ability to buy. We've got a big line of credit, so it really depends on where we think the market is, where the cycle is, where we are. We can always be buying, or we can always choose to not be buying. I lived through 2008 at a public company. I remember the times when we sat in meetings and I was told, yep, we're a buyer, we're in the market, 14% yield. That didn't exist, right? So we were out of the market for a little bit. As a public company, you're a little more at the whims of that. If we have another 2008, I think everybody's probably in a different situation. If we have a little bit of a slowdown, that may not impact the public companies as much as it may impact institutional investors or private capital. It really just kind of depends.
Surprise is really the element that seems to screw the markets and put a damper quickly on flow of capital back and forth. Okay, so there's a downturn in the economy. I mean, in general, I think people are predicting that now for a while. Hasn't slowed down investor appetite. If anything, it's oriented people more towards defensive, cash-yielding investments. This is what this sector is generally all about. What can be problematic is if some exogenous risk comes out, be it geopolitical or otherwise, that is not anticipated by the market. That's where it's going to hurt everybody.
How often do you spend time, the 4 of you, thinking about or discussing, analyzing, underwriting those exogenous risks? Is it something you can't control and it is what it is, or do you spend a lot of time debating internally?
We have some pretty good discussions internally about those things. I think we've got a great senior leadership team that has lived through many things and has evolved the business tremendously from when we started Ventas and spun out of Vencor. And so they're always thinking about what's different, what's next. I'm always amazed at the number of exercises that we're running. Just the what ifs, the just in cases. So that's one of the great things about being at Ventas. It's one of the draws that brought me back to Ventas. When I left in 2018, I told Debbie Gaffar, I said, this group of people I'm working with are the smartest group of people I've ever worked with and that I probably ever will work with. No offense to my former teammates, but just the level of knowledge and the level of thought that we put into our business and where it's going to go. But we spend a lot of time thinking about that and how we need to react and how we need to be prepared to react.
I mean, I think an impact, if there's an impact to the economy, then all asset classes, inevitably suffer. But the draw to medical office or one of these demographic-driven sectors is that, at least in the medical office space, there is some historical performance that would trends that suggest that the product type can endure if you have patient capital.
It helps being a developer to be in the forefront of technology, technological change, design change, to really evaluate a new investment and make a determination as to whether that location and that physical plan is going to be, that infrastructure is something that one could envision having a number of uses for if it ever came to that. So back to the question about primary, secondary locations, again, the more main and main type of site you own, the more you can envision doing any number of things with that, such that if there's ever a problem, okay, I still own a site in a building that could be repurposed to do X, Y, or Z. Hard to always answer that question in more remote locations.
You know, I think for us, when we think about, recessionary risk or any of these, how it's going to affect our pricing and valuations, at the end of the day, we're very disciplined in terms of finding that product and creating these investment vehicles for our investors that meet, those guidelines that were kind of pre-described when capital was allocated. And so for us, a lot of times, that while that provides some protection from kind of some of the fluidity in the market, we don't operate in a bubble. But one of the things that has strengthened our thesis and makes us feel so confident in our MOB thesis is that, we're going to perform the way that as part of the larger investment universe, right? As recession comes or we have any of these types of, external threats that create shock, we would expect to still continue to outperform as the market shifts, and that a lot of times provides a lot of comfort in terms of us not having to necessarily think too far outside of the box in terms of our valuation. We just remain disciplined, pretty much.
Thank you. We've got 15 minutes left, Mike Hargrave, is that right? So I've got a handful of questions left I'm happy to get to, but let's turn it over to questions now, make sure we have time for those. If we have time, I'll come back some
I'm not
questions.
answering Noto's question.
I've got a question for James.
Good.
So when I thought back in the day, Paul and Lou days, when I was a banker, I thought developer. And today, you guys are doing a lot of buying portfolios, stabilizing buildings, et cetera. One, part A, did it require a change of culture within the company? And two, did you have to, restaff, or did you have to bring in different types of folks?
Great question, Mike. So Ben, my partner, I think disappeared.
I saw him back there somewhere.
He was here at one point, but he's gone. So Ben Oates, my partner and anchor, had come up under Norm Brinkman at Brinkman Management Development, merged this platform with Lou and Paula's legacy anchor Health Properties in 2015. So Ben's primary focus and background was management with a secondary focus of development. Lou and Paula were primarily developers with less of an emphasis on management. Then put those two verticals together. I left C&L, joined him in 2016, so came from an institutional investment background. We've got now 3 verticals that all really play off each other. We look at them as complementary in a lot of ways. I described some of the things that our current platforms lend to each other as we make new investments, as we make new developments, as we bring on more square footage to be managed. So I think that the growth has been complementary in that regard. We've absolutely had to staff up, really become more of an institutional infrastructure. I think pretty much everybody on this table works under an institutionally designed infrastructure at this point. We have institutional capital partners that range the gamut, and they all expect a certain level of reporting and accounting and asset management and really infrastructure, and that was not necessarily what the legacy, where I'll call more free-spirited development platform of yesteryear was. So we've had to institutionalize to be able to grow and scale up. Is it different? Yeah, it's absolutely different than what it used to be, but I do think having the three verticals gives us good balance and good insights that each contribute to the different lines that we're growing.
Are you growing, is it kind of three separate verticals and three different types of people, or are they working cross-functionally?
I think we
within
do a
your
pretty good
organization?
job of working cross-functionally. My colleague, Mr. Merv Alfonso out there, is
Also my former colleague too, I want to point out.
a good example of someone who works across development, investment, and management platforms. We've got a number of folks like Merv that are multi-talented, that have experience in all of those different reaches of the business, have been doing this a long time, and who are able to add a lot of value across the platforms. In general, people orient towards one of those two verticals, but I will say that there are any number of times where people cross over and contribute to different things we're doing in a different vertical. So we just bought a project here down the road in Palm Beach, closed last week. Our management team is going to take over operations there. Our development team is going to manage through a $4 million capital project led by that guy over there, Eric Moser. So, all three of those verticals are going to contribute to an acquisition that brought us into a new market, and I think they build off of each other.
What about you, Farron? How does MB do it? I mean, you've got kind of those same three functions too, right?
Yeah, exactly. And we definitely take advantage of some cross-functionality. So obviously, I can speak for myself, sitting in the acquisitions vertical. We spend a lot of time I personally, in the asset management space, the property management space, and it just allows us to take advantage of opportunities that would otherwise go unseen or unlooked yeah.
I have a question, Mr. Klein. As a deputy chief, do you have arrest power?
Don't make me get my badge out, okay?
Oh my God.
Are there any better questions?
Something with crawdads in them, perhaps.
There's a couple of you that are missing that, so.
That's true.
I can't quite see, but if there are, yell. Otherwise,
Deanie's
I'll
always got
keep
a
asking
question.
questions.
What's the question, Deanie?
So panel, Medicare for all, or all who want it, or a public option, do we see it in our careers? And if so, how does it affect what we all do for a living?
I work for a public company. I'm willing to jump on that sword and make statements that I'll probably get in trouble for. I think that it's an interesting dynamic to talk about Medicare for all. Does it happen tomorrow? Probably not. There's enough people that probably don't want that to happen tomorrow, but as we look at the generational change that's occurring and the young generations today that feel like that's a right rather than an option for us, it's a right that you should have, just like climate change is much more important for a younger generation. I don't think it happens tomorrow, I don't think it happens in 5 years, but in 30 years, maybe we're there. But then you take it back and you look at other countries like England that has a Medicare for all type program, and in order to move up in the queue and actually be seen by a doctor, you need to have private insurance. So maybe it's some mix of that is what ultimately comes out. But I think if I'm a healthcare provider, and by no means am I a healthcare provider, and by no means should anyone ever hire me to operate a hospital or a healthcare facility, but if I'm looking at that, and I think that in 30 years, I'm going to have one payer, and everyone's going to get to choose in this room where they want to go, it's going to be the choice of which facility, which system do I feel most comfortable with. So I'd be focused on branding, I'd be focused on marketing. Quality of care is important, but as we all know, Starbucks is a great example. For those, I'm not a coffee drinker, but for those of you that are coffee drinkers, you may not like Starbucks, but guess what? There's 1,000 Starbucks to go to, so you're probably drinking Starbucks. So I think if you're going to be a healthcare provider, at the end of the day, a knee replacement's a knee replacement's a knee replacement. There's better surgeons, there's worse surgeons, but I'm only going to have it done one time probably. So as long as I have a pretty good read on that surgery is going to be pretty good, I'm going to go to the best facility, the one that I feel most comfortable with, and that's probably going to come through branding and marketing, most likely. That's how a lot of things work in our life now. Consumerism is a real thing in this country, and we all choose based on what's put in our face on a daily basis. So if I believe as a healthcare provider that Medicare for all is where we're going, I'm probably really focused on how my facilities look, what the message is that I'm telling you as users of healthcare or consumers of healthcare in the future, why you should come to me, and why my facilities are better, and they're gonna probably look pretty nice when you walk in the front door too.
Anybody else want to chime in on that, or is that a sufficient response for the group?
I just made that up.
It was good. Any other questions? Okay, so we'll wrap it up here in a minute or two. What's one thing that could happen in 2020 that would have material impact on pricing?
If we knew that, we could tell you what that Black Swan event was.
I know it, I just can't
Yes.
tell you.
Exactly.
Now, let's say Trump gets reelected and surprisingly picks up some votes in the Senate and takes another run at repealing the ACA. I think that could have...
Well, not only that, the Supreme Court said they're not going to do anything about the Affordable Care Act that's being thought about until after the 2020 election, which, if Trump's reelected, that will come back up. And if the Affordable Care Act gets taken out, like some people want it to, that will have an impact.
And I think, we're hearing across our platform that investors, at least in like the big asset classes, are anticipating a big first half of the year from a sales velocity perspective and a slower second half of the year. So, as everyone's in a wait and see to see who's ultimately in office in a year or so. So less product in the market could potentially put even more, pressure on pricing, I would think.
Yeah, I keep hearing, people always tell me in the last few weeks, like, first 6 months is going to be great, then everybody's going to slow down and be patient and wait and see what happens. I just don't believe it.
I'm not seeing it, we're not seeing it in medical office, but we're such a small component of the market that sometimes it's hard to recognize trends like you can in bigger asset classes. I agree with you, Dan. Yeah, I'm not seeing the slowdown.
I think for us, sometimes, the low probability events are interesting. It's interesting to talk about what happens in the event of, Trump getting reelected or, XYZ external event happening. But at the end of the day, I think the biggest driver that's going to make an impact for 2020 valuations for us is just the continued inflow of capital at the end of the day. And, I think one of the things, we're always doing market research. We came across a really interesting report that Cornell put out, their real estate group at the end of 2019, and 212 institutional pension funds from across the world, basically indicating that they wanted to increase their allocation for real estate, and to the tune of about, 10 to 20 bips. And that the real estate allocations that they currently had were actually underweight. And when we quantified that, it was like, we could be seeing easily north of $400 to $500 billion moving into the space, with, of course, medical office getting, we think, a very healthy chunk of that because of the very attractive risk-adjusted returns on it.
So maybe we get 10% of that, that's $40 billion.
We would just need 4 times the volume.
How much did we sell last year as a market? Was it 12 billion, 15 billion?
Precisely. So, thus, it seems really obvious because we've all been talking about how much capital is coming in, but, we just can't, emphasize it enough. Like, that's just going to have continued pressure on cap rates.
So does that drive, nobody on this platform, does that drive some people out of business that are in the business today?
Money's got to go somewhere. I think you have to, Mike asked about developers before. As a developer, it's harder and harder to be a small developer.
Before we adjourn, I want to thank everybody. Thank you, panel. Fantastic. Appreciate it. Thank you for attending.